Okay, we'll now do a quick round of questions. Anyone can participate, and I will refer to some of the comments that we heard. You know, I once asked a Nobel laureate in economics to define economics in one word, and he thought, and then he says, if it's one word, then it's incentives. And I'd like to talk about incentives with all of you. I'll start with a very short question to you, Professor Trachtenberg. You said that the academia, your profession, economists have betrayed you, and maybe they have betrayed not only you, but they betrayed society. Maybe this is because the same skewed incentives that we see in government, in capital markets, they also, in the case of the academia, wrong incentives.
I believe that that's true. I have to be careful with my answers because now I'm the one that provides incentives through the budgeting of the higher education system.
I am aware of that.
So I have to be very careful with that. But yes, I mean the incentives in the economic profession are very similar to other disciplines in the sense that you have to publish or perish, okay, and there is certain set of rules, and there are paths, and yeah, this is not working. Yeah, this may sound now more convincing. So there are a set of rules that you follow if you are an aspiring a professor and so forth, and the issue of relevance to society, to the economy, to policy, does not figure prominently, if at all, in what you do as an economist in academia. And let me say something that, I don't know, it's the first time I hear myself saying this, so I don't know how I would react to it. I think that you should demand that. You, meaning everybody around. I mean, the press and the people.
We will talk about the wrong incentives in the press.
Yeah, right, also. But in the following sense, and let me be more precise, people demand a cure for cancer, okay? And that filters through the politics of science and so forth and so on, and academia as well. People demand that. People don't demand, in the same way, a model for growth with fairness from economists in academia. So, you know, I throw the ball back to you.
Yes, but Mr. Gore, you are an expert on healthcare, and Professor Trachtenberg said that people demand a cure for cancer, but many people in the healthcare industry want to provide treatment for cancer and not the cure for cancer. Again, wrong incentives in many parts of the industries around the world.
Well, I think the issue of incentives is actually very central. One of the, and I say it with respect to the economists here, the idea that people are rational, which is a kind of the underbelly of classical economics, as I understand, is fundamentally wrong, I think. And we're seeing more and more about behavioral economists that the idea that people are irrational, they act with prejudice, they act with bias. In healthcare, you see that all the time. Why would someone smoke when they're kind of assured a painful death down the line? Why would they do it? You know, and we know well this paradox of healthcare, that healthcare is overconsumed, wellness is underconsumed. And as you analyze the reasons for that, you find it's entirely incentives. Healthcare in most countries is either paid for by government or by insurance, which means at the point of care it's free. But the benefits are immediate and demonstrable. You go to hospital and you feel the treatment. In the case of wellness, the benefits are 20 years down the line and the price is immediate. You've got to go for that run, or you've got to not eat that fatty food. That's difficult for people. And so rationally they should behave differently, they simply don't. And that's why we find that the use of incentives to change behavior is so fundamental. I would say to you that with the right kind of incentives, if you can understand people's bias and prejudice and deal with that, we could save the healthcare system huge amounts without even worrying about the curative side of care. I do agree with the professor, the issue of curing cancer is fundamental, but wouldn't it be wonderful if we kind of didn't get it in the first place? That must be the first prize. And more research about physical activity, nutrition, better living has a fundamental impact on that potential. I think that's a function of incentives and education.
Sir Cohen, you worked for many, many years in private equity and venture capital in the business sector, and you've seen the market failures. And in the last 10 years, you work a lot with governments, and you are aware with government failures. And now you're trying to bridge them both. How is it?
I think this focus on incentives is right. When I started out in the venture capital business, I was 26 in 1972. And people talked about the need for innovation and entrepreneurship. And we could see that big companies weren't in the right position to continue to create employment. In my own country, in the UK, there were 3 million people unemployed. And governments thought that they need to create jobs by organizing industry. So the car industry, which was declining then in the UK already, was forcibly merged. Eventually it went bust. And a change of mindset was required to bring to us the chip, the PC, the internet, the cellular phone, the human genome mapping. A huge revolution was created just from this notion that you needed innovation. I think we're at a stage now where the mindset of government and the mindset of the private sector and the mindset of the social sector, I always thought, Professor Trachtenberg, the third sector was a very pejorative way to describe people who are spending their lives helping others. So I prefer the social sector. And I think we're on the threshold of a revolution. And it isn't anymore a question of persuasion. It's becoming based on evidence. Goldman Sachs have issued 2 social impact bonds in the United States, one in New York City to deal with recidivism, one in Utah, in Salt Lake City, to deal with early education. The G8 have set up a task force to look into how social impact investment can help tackle social issues. I'm privileged to lead that task force. But within a year, I hope we will be able to report in a way that is going to help provide an answer to your question, Guy. What policies are required in order to do with social issues what we did with tech and with other entrepreneurship? What government policies are required to create an enabling environment? Government didn't do tech. Government created in Israel the Yozma scheme to get venture capital funds going. The supply of money created its own demand. Israel became, alongside the United States, the leading power in this area. We will focus on the measurement of social return. What is the watershed? What is the watershed that has taken place to make that revolution possible? It's the realization that you need to measure social outcomes. If a not-for-profit or if a for-profit that claims to be trying to achieve a social object as well as a financial object claims to make social improvement, it can actually be measured. For long, we thought it can't be measured. For long, philanthropy has focused on the act of giving. Once you've given, it's the job of somebody else to do with it. 2 or 3 years from now, go and raise money from somebody else. Don't spend any money on your overheads. But it's been, it really hasn't been that helpful. And so I think now focusing on the measurement of social outcome and focusing on allocations by financial institutions, how do governments provide an incentive to financial institutions, not just foundations, but pension funds, to allocate a percentage of their assets to impact investment? I think, if I'm right, 10 years from now we will look back, we'll think about this meeting, and we'll see that it was a turning point. That in Israel, there's social technology that's tackling education problems, that's tackling homelessness problems, that's tackling health problems, a myriad other problems. And the same will be true across the world, and technology, social technology, will travel across the world, and new benchmarks will be set. We need to harness entrepreneurship and capital markets to tackle social issues. Without government creating the enabling environment to do it, it can't be done, Guy.
Okay. Abby Joseph Cohen, some of the comments we heard about the importance of free markets and capitalism, and I think those were two professors, two economists from Chicago that 10 years ago wrote a book about capitalism and the saving capitalism from the capitalists. So capitalism works fine if we only eliminate the capitalist. You work in Wall Street for many, many years, and you know a lot about incentives and maybe something about also wrong incentives and also about capitalists, how they interfere with capitalism.
Okay. Clearly a very provocative question, but a very important area. Is there one of the things to keep in mind is a statement that was made by Adrian earlier, and that is the problem is not capitalism. The problem is what happens afterwards. And I don't want to use this as an advertisement for Goldman Sachs, but let me say that in addition to the social impact bonds, we very much are involved in philanthropy, but philanthropy of a different sort, a sort that Sir Ronald is very familiar with and is relatively new, and that is philanthropy which is benchmarked. It's not about giving the money and putting your name on a building. It's about having an impact. And so, for example, Goldman Sachs, which is the second most philanthropic country in the entire United States, even though we have only about 25,000 employees in the United States, doesn't make us that large, focuses on education needed primarily by immigrant working families and how they can bring themselves up into the middle class, and also education primarily of women in the emerging world, because the research we've done shows that there's a higher multiplier effect, for all of you economists in the room, for educating a woman. If you educate a man in the emerging world and his income rises, he spends the money on himself. And shall we say, for some activities that may not be all that socially conscious. Instead, when you educate a woman, the economy tends to grow 30% faster than it would have done because she's educated, her children are well fed, are well cared for, and they too are educated. But I want to go back, if you will, Guy, to maybe a point that you were more specifically focused on, and that is what happens with the fruits of the capitalism? How is the money used? And one of the things that we have discovered is that our shareholders, our stakeholders, and I'm not referring to my company, I'm referring to stakeholders for other companies as well in the United States. It's no longer about the specific return to the stock market, but rather the overall impact on the community, on the employees, on the environment. Let me give you a few examples. Over the last 10 or 12 years, many of us who have been involved in climate-related issues, including carbon and water and so on, have been very disappointed because there has not been very much legislative development and progress in this area in the United States. Yet, we have become dramatically cleaner. Our carbon footprint has gone down dramatically, for example. And if you look at a whole host of other issues, you find out that we have become much more energy efficient. And the question is, why has that happened? It has been led primarily by the business sector. The second thing that we see among this new generation, we've talked about social movements. Many generations can be involved, but we do see great leadership on behalf of the so-called millennial generation. They care about any number of these issues. And what we find at our company, and I'm sure this is true for many others, is that the fact that we have an active philanthropic program, the fact that we have a very green footprint, the fact that we get involved in so many of these broad issues makes us a more attractive employer. It allows us to recruit the people that we want and to retain the people that we want. And we survey our workers on a regular basis, and we say, how important are these initiatives to you? And they say, very important indeed. So I think it's a question not of, is capitalism broken, but let's focus in, using the themes of this conference, let's focus in on what do we do next? what do we do to improve the situation that we have? And I do concur with the observations made before. It's about adding the right incentives. We have to have certain incentives in the business community.
And maybe eliminating some of the incentives.
I'm sorry?
And should we also eliminate some of the incentives?
Well, you need some incentives, obviously, for companies to make a profit. If they don't make a profit, they go out of business, and then where are you? People don't have jobs, et cetera. And I think that what we have learned following the crisis is that some incentives were inappropriate, or some incentives were not appropriately matched by risk measurement and so on.
Have we made significant structural changes to the incentives schemes in the overall market?
I can speak for the United States and then a little bit on other nations. We have passed very dramatic legislation in the United States. Dodd-Frank, for example, addresses many of the issues, not necessarily all. Let's keep in mind it wasn't only one or two economic players that were involved in making bad decisions, but many others. It may have been financial investors who were willing to take on too much risk. It was households willing to borrow money they couldn't pay back. It was credit rating agencies who put ratings on things that were not of the quality that they said, and so on. And I would add that the Federal Reserve and other regulators have stood up and said maybe they weren't watching as carefully as they needed to have done. So when you have a crisis and when you can do the analysis afterwards, you can think about what you should have done differently and try to correct it. In my area in investment research at Goldman Sachs, we have a team that is focused almost exclusively on how regulation can be improved. Because keep in mind that we are very active participants in the market. We have a vested interest. We have an incentive to want those markets to be robust and vital. And the last thing we want are people on the other side of a transaction or others in the investment community or the banking community to not be handling things the way they should. That is dangerous for us. What is best for us are participants in the markets that all have good incentives, good risk measurements, and are handling their jobs the way they should.
Lord Skidelsky, we heard from a few commentators this morning that we are in a crisis, we are in a turning point, we're at an important point. What does history tells us, if it does, about who are the people that will lead us out of this path? Is it the academia? Is it historians, politicians, business people?
I'm going to talk about that tomorrow. So with respect, I won't answer that question. But I will make a comment on the quotation from the Nobel laureate with which you started, that economics is about incentives. I simply don't agree. I think economics is about a rather narrow set of incentives which are measurable in money. And there are lots of incentives for human behavior that are non-measurable and on which economics has absolutely nothing to say whatsoever. That's my main point. So I think a lot of the discussion is quite narrowly focused. All right, it's on economics, but let's be aware of the limitations of economics and not think that it's a general science of incentives, because it clearly isn't. Then on a small point, I have to disagree with Adrian on one thing, when he says that as an example of people's irrationality, he cites smoking, which, in his words, ensures a painful death further down the line. It doesn't. It heightens the risk of a painful death further down the line, and therefore the choice whether to smoke or not to smoke can be a perfectly rational choice, as Gary Becker, Chicago, pointed out years ago, depending on one's rate of discount. And that is also true about climate change and a whole lot of other issues, in which you have apparently a very strong moral argument or health argument of going one way, which simply ignores the rate of discount. And so that's a subsidiary point. My main point, really, is that economics is not a general science of incentives, and it skews all our argument towards money and GDP if we think of it as that.
I actually I agree and I don't agree in the sense that it clearly is an issue of at what rate of interest you discount the future. But we seem to be understanding that more and more people have what we call hyperbolic discounting. It's not a rational process. They discount the future at ridiculously high rates, and therefore instant gratification tends to drown out the potential dangers down the line. So I do agree. I think that it can be a rational choice, but my sense, and certainly in the work we do, we see that people aren't making that choice rationally. They just don't really consider the future, and they suffer from what we call over-optimism. They believe they will ultimately get to grips with it and give up. So I think I do agree, but I think that the level of rationality in that choice, I think you're overstating, but I respect the comment.
Guy?
Yeah.
I'd like to introduce a topic that I think Adrian briefly touched on earlier, and that is the role of investors in pushing things in the right direction. One of the things that the academic community, in my view, did a poor job on was the analysis in the 1980s and 1990s that basically said that portfolio managers who focused in on good things like clean air and not owning companies that produced dangerous products, including tobacco and so on, that the portfolios that tried to avoid those exposures, in fact, didn't perform very well. They tended to underperform the overall stock market. And so we ended up with many years in which the view, at least in the United States, was that if you had a fiduciary responsibility running a pension fund or running the endowment for a university, you really should not be looking at socially conscious portfolio investment because your pensioners or your students who depended upon the endowment for their scholarships wouldn't get as much money. The academic community gave us the wrong answer because their analysis was incomplete. What they forgot about was that very few investors were looking at those issues. And if nobody is looking at an issue, it's not priced efficiently in the market. That is, the stocks of some of these companies that were doing things that were wonderful were not being given the premium that they should have been given, either in terms of a PE ratio or perhaps their bond yields were priced too high. And something that we saw before the financial crisis, and we're hoping we will see it again sometime soon, is that in the 3 or 4 years before the financial crisis, so basically between 2002, 2006, the companies that did well in terms of various metrics, climate, taking good care of their workers, worrying about a whole host of other social issues, in fact, generated higher PE ratios and had lower cost of debt capital than their competitors in the same industry who did not pay the same kind of a level of attention. Now, since the financial crisis, as you know, the markets have been torn asunder in many different ways, but we'll be watching very carefully to see if there are enough portfolio managers out there paying attention to this and willing to pay that increment for the companies that do well on these particular social issues.
So, go on.
Avi, just continuing on from what you're saying, the minute you begin to measure social outcome and arrive at a measure of social return, you develop a spectrum of investment opportunities that have combinations of the two. A foundation that has charitable objectives to help prisoners may accept a 3% return, financial return on a social impact bond or a fund that's helping prisoners, and expect a social return of 9 or 10% in order to arrive at a 12% yield for an investment of a particular level of risk. At the other end, a financial investor like a pension fund may expect a 9% return instead of 11, additional social return and some downside protection, as has been provided in the social impact bonds that Goldman Sachs has been involved in. I think to the extent that we begin to measure social return and companies that are for-profit begin to talk about the social return that they achieve, you will begin to get a different form of pricing in markets. A social stock exchange has been created in the UK, in which big society capital has invested. There is going to be a social capital market. Certain types of investors, like foundations, for instance, are going to be interested in funding at lower financial cost things that can achieve a high social rate of return. So I do think that we are at the threshold of a revolution in the way in which we begin to take into account social impact.
Professor Trachtenberg, I didn't succeed with Lord Skidelsky because he's saving ammunition for tomorrow. So I'll repeat the question: who will lead us? Who are the people that will lead us out of this path that we're in?
I have no idea. If I knew, we're making money on it. Right?
We need people that are not only money motivated.
Right. Let me rather than answer that question, say so, yeah. No, let me say the following. I mean, because the issue of incentives is really very much hanging here in the air, and I want to try to reconcile the things said here. It's very dangerous to push somebody to give you an answer in one word. That if I ask you how you're doing today in one word, you say great, and in 2 words, not great, right? So it's very dangerous. Essentially, incentives, yes, are incredibly important. But incentives, again, construed in a narrow sense, are incredibly dangerous as the only way we think about things. And so when we think about the design of economic models, because that's essentially the issue, design of economic models, if the premise is that the behavior of people is just according to what we call in economics homo economicus, in Latin meaning the economic man, meaning by that you are just a calculating machine. You take in data on prices and the environment and so forth, you maximize your utility function, you produce behavior. You tinker with that with incentives and you change your behavior accordingly. And if we model our thinking and government policies and everything else just according to that, we're going to err big time. We do, and that's what I'm saying, it has to change.
We do.
Okay, exactly. And let me add to that then 2 things that we know, we have known for long. It's not just the behavior of people, it's not conditioned just by that. Homo economicus is also homo moralis, which means that people also take into consideration moral issues per se, not just in the way they affect your immediate well-being as an homo economicus. And the third one is what you call irrational, but we know enough now from Kahneman and Tversky and others. It's not really irrational. It is that your behavior can be termed, and this is a term that I'm playing with it lately, homo, it's called in Latin temerarius, which means literally your behavior could be casual, rash, impulsive, imprudent, etc., which is the psychological aspects, okay, that play a role beyond what can be rationalized with our models. Our behavior is the result of these 3 motives, okay, the homo economicus, the homo moralis, and the psychological man. And we have to take the 3 of them in modeling the economy, our thinking, etc., etc. Because if we are going to limit ourselves just to one of them,
you're talking about you're talking really about the whole reconstruction of economics. Economics can't model all 3. It can only model one of them. It doesn't have models. It doesn't have metrics.
I disagree with you. I mean, Kahneman and Tversky and the work that is being done on behavioral economics has developed a huge literature that can help us in design better models that take into account those aspects. And with respect to the homo moralis, I think that this is the best example of how an economist can cooperate with a philosopher. You told me that your son is a philosopher, right? To produce some better thinking. I hope you wouldn't disagree with that.
But that thinking isn't economic thinking. It's a cooperation, as you say. Well, economics may need to cooperate with lots of other disciplines, very importantly. But that tight modeling, mathematical modeling, does depend crucially, I think, on your first proposition, which is on Homo economicus. And it's never been able to break free from that. It's tried many times to break free from it, but always it's dragged back to it as a sort of almost a center of gravity.
Okay. That's the challenge.
So, so this murderer gets the capital punishment, and he was sent to an electric chair. And the day they're supposed to execute him, turns out that he's too big for the chair. So the judge says, send him to his cell and put him on a diet. Next week, they brought him again to the chair. Again, he's still too big. So they do the same thing for 3 months, and still he's always too big for the electric chair. So the judge says, bring him to me. So he goes to the judge, and the judge says, you know, I've been sending you back and forth to the electric chair in the last 3 months. What's happening? So he says, I think there is a problem with incentives. Questions before we end the panel, please? Yes, please. More questions? Yes?
To what extent do you not think that the kind of monetary policy that has been pursued worldwide in the last couple of decades, and especially in the last few years, is simply exacerbating inequality? Because a lot of money is being printed, is not going into real economic activity. A lot of money is being printed, it's not going into real economic activity and job creation to the extent that it should. Instead, it's going into pushing up financial asset prices, which benefit a few of the beneficiaries, but at the other extreme, we're not seeing job creation.
Abby Joseph Cohen, you want to take this?
The last question. With regard to that very important question on monetary policy, I first of all would disagree with one aspect of it, and that is monetary policy over the last several years has been actually quite different. It's been in different phases. So before and we agree, right? So before the financial crisis, we had a situation where we had relatively low interest rates and very good availability of credit. And one of the concerns, of course, is that much of that credit was taken on for purposes that ultimately did not pan out. Housing, a good example in the United States where money was borrowed by people who could not afford to pay it back and so on. And so people who study monetary economics would argue that because interest rates did not properly match the intermediate to long-term risk, bad decisions were made. That is a simplistic economic model view of it. We've already talked about the problem with economic models. There were a whole host of other issues as well. When we look at the post-crisis monetary policy, we see that interest rates are being kept very low to prevent a very significant problem. And I would say, I know we have very limited time, so I'm going to try to keep this answer.
No, we have a full house here, and I think we
Okay.
should quit while still we are hit, and
Okay.
before people start leaving.
All right, so the way I would look at what's happening now on monetary policy is that it's being used primarily to keep the world out of recession again. The most important thing, the most important objective for central bankers right now is to keep economies growing so that there can be job creation. And in the United States, the Federal Reserve has stated very clearly, and maybe they'll change things in the FOMC meeting and minutes being reported out at this time, but what they have said is until unemployment is down substantially, and the number they're using is 6.5%, down from 11% at the peak, they're not looking to change interest rate policy, but they have learned the lesson. They have learned the lesson that interest rates that were too low, that provided one set of incentives without providing the regulation on using that. When I say regulation, I'm talking about people deciding for themselves that maybe they should not be doing things. I'm going to state it in a very simple way. And that is, if your cost of borrowing money is lower than economic growth, if your cost of borrowing money is lower than growth in income, then you have a mismatch. What we now know is that is an unstable situation. Instead, what gives us stability is when the cost of capital is at the growth rate or a little bit above it. Because then there's a real cost-benefit analysis. So when we take a look at the low interest rates...
we do have to end here.
Okay.
I'm sorry.
One half sentence. If you take a look at the low interest rates for the last several years, in the first, everyone now agrees it was a mistake, but now the feeling is this is what will keep us out of recession. When unemployment goes down, that's when you need to look for the rise in rates.
Okay. Thank you very much. Thank you all.